podcast We Make Money Fun, and third Thursdays at 3. I know it's the fourth Thursday at 3, but I wanted to go live with this podcast recording because I get so many questions about why folks that come in to see us shouldn't just invest in the S&P 500 as their entire investment strategy. And so we're going to talk about that today. First, let's define what the S&P 500 is. It is a stock market index that measures the performance of the 500 basically largest companies listed on the U.S. stock exchange. And it was created by Standard & Poor's, thus the S&P, and it's widely considered to be one of the best indicators of the overall health of the U.S. stock market. It is the most broad of all of the stock market indexes. It does cover a wide range of sectors, including some technology, some healthcare, some finance, and consumer goods. It's really become a favorite of a lot of finance writers over the years. And because it's an easy way to get the most broad diversification of any index, it's really become sort of a mainstay of some of the finance writers that are out there. A lot of investors also use it as an investment in their workplace plans because there's almost always an S&P 500 index fund in their 401ks or 403bs. And while it's the best of all of the indexes, it is not the best way to invest. And the reason is, in our opinion, that there are risks investing only in the S&P that don't exist when you diversify more broadly. So the S&P has historically performed well, but it's important to understand that it's just one index and represents only a small portion of the available investments that are out there. So you can be subject to greater volatility when you're just investing in the S&P rather than a broadly diversified portfolio. So if we look at what the S&P is comprised of at any given time, and this can change depending on what day or week or month you're looking at it, there's about 30% of it in growth type of investments, 21% of it in value type investments, and about 49 to 50% of it in what we consider a blend of different types of investments. So really kind of three main categories. And when you look at the entire market, there are far more categories than that. And so it's important to look at adopting a more diversified investment strategy. That may bring with it some higher fees because there are some categories of investments like international that carry with it higher fees than the S&P. And also to consider doing some actively managed funds. I don't think every person needs all actively managed funds, but it is important to consider the risk and return perspective of actively managed funds. So it's important to look at those expense ratios and costs when compared to returns. And so we just really need to consider some times when the S&P itself, investing in the S&P as your only investment strategy, may have been a bad idea. And first, we'll start with the most recent. During the 2022, the S&P was down about 25%. If you were in a broadly diversified portfolio, you could have been down about half of that in that same time period. During the COVID-19 pandemic, the S&P over the March and April timeframe lost about 34% of its value, and it was much less than that in diversified portfolios. During the global financial crisis from 2007 to 2009, the S&P lost pretty significantly. It did recover, but it experienced, in some cases, 50% or more losses during that time frame. And then, of course, during the dot-com bubble, which was 2000 to 2002, and during the late 90s and early 2000s, there was a large loss in the S&P when those extreme valuations corrected. So it's important to consider that the S&P 500 is not a widely and broadly diversified portfolio. There are other categories of investments that you should look at. And so, what we usually recommend for a diversified investment strategy is a mix that includes all asset classes and sectors, like bonds, which are not at all represented in the S&P. Bonds provide stability and are the best type of stability for a lot of older investors that don't like the wild ride of the S&P or the Dow. And so, those are, it's important to consider bonds' place in your broadly diversified portfolio mix. Um, Also, there are some other equity classes that you could buy in the form of ETFs, mutual funds, or individual stocks that aren't in the S&P 500. The other thing that's not in the S&P 500 are alternative investments like real estate investment trusts or REITs. We always recommend a small allocation for most clients in those types of investments, and those cannot be found in the S&P 500. So, how do we manage and mitigate risk or potential losses in our investment portfolio if we want to diversify outside of the S&P 500? Well, first, we need to diversify their portfolio, meaning we need to not put all of our eggs in one basket. I know that your parents and grandparents may have said that. Mine said the same thing. And so we want to really diversify between all asset classes, sectors, geographic regions, and all of the other factors that we look at to make sure that all of our eggs aren't in one basket. If alternative investments are appropriate for you, we want to consider those. Those are things like real estate, commodities, private equity. And if you're a more sophisticated investor, you can take a look at those types of asset classes which aren't also in the S&P. We also want to rebalance the portfolio regularly. So, rebalancing the portfolio to maintain our desired asset allocation helps us manage risk and minimize potential losses. So, we sell assets that have performed well and invest in assets that have underperformed. And that is counterintuitive to what most people think, but it is absolutely the right thing to do when you're rebalancing a portfolio. And most importantly, we have a very long term time horizon. So we're going to be looking long term, especially if you've got a number of years or even decades before you get to retirement. And we're not going to be concerned about short term market fluctuations. We're really investing for the long term to make sure that we keep our eyes on the prize, which is that long term goal. So hopefully that has helped you understand why the S&P 500 might not be your best investment strategy. If you'd like more information or would like to chat with us here at Heritage Financial Strategies, you can go to our website at heritagefinancialaz.com, click schedule consultation in the top right corner, and we'd love to chat. Thanks so much for being here with me today.